All right, we are wrapping up this conference with a very special treat and a very robust panel. I think this might be our record. Peter Evensen is moderating this session. He's right here. I got him. Peter also needs no introduction in this world. He has been in the ship finance business for how long, Peter?
40 years.
40 years. Still learning every day, I'm sure. And started his career as a banker and went up sort of the traditional route through manufacturers Hanover and Chase and JP Morgan, and but then became the CEO of TK Shipping. And it was there that he really got super active in the capital markets, really, I would say, kind of creating the idea of creating, is it fair to say? Spinning out companies to try to maximize the value of different kinds of assets in different public companies. And has really kind of set the stage for the shipping equity market that we have today. So he's played a huge role in that. And then in more recent years has been doing investing himself, I believe. And we have this fantastic panel, and we're going to talk about sort of what it takes to make money in shipping. And so really happy to have all you guys. And Peter, thank you very much for being with us today.
Great. Okay, let's kick it off. We have an all-star panel. We have things no one ever knew existed before, influencers. And we have investors, and we have equity analysts, and we have equity analysts who are also investors, and equity analysts who became investors. So let's get into it. And so we're going to get to top picks that everyone has. But first, I really wanted to get a better idea about why we have the best of times. We have VLs at 50,000. We have Capes at 30,000. MRs are jumping here, triangulating. And yet, we're Rodney Dangerfield. No respect. Investors give us no respect. Trading, everyone's talking about at less than net asset value. So talk to me about who are the natural investors in shipping, and how are we going to get them in? Joakim, you want to start that?
Thank you, Peter. So short about me, I run Gersemi Asset Management. I'm the founder and CEO, and we have a shipping fund. I think that the market or our industry is cyclical. And I think that goes for capital flows as well, and different types of capital. So when we are at the trough, we do see the industry, kind of the shipping experts moving into the sector. And they buy then based on NAV and hopefully then below asset prices at a discount to NAV. And then as the cycle matures, you get into the expansionary phase of the cycle. And then you're going to see more generalist capital coming in. Usually the big push in equities and also potentially asset prices is when the US generalists come into the market. They have so much capital. And then coming up to the cyclical peak, it kind of matures and you kind of have a different capital structure again. And I think right now, one of the reasons we are priced below asset values is because the assets aren't really returning the expected return on capital employed, and also because I think due to all the geopolitical risk, the risk premium is quite much higher than it tends to be in any market.
Tate, you guys have done a whole bunch of deals. Who are these investors? Hedge funds, long only, family office? Who are they?
Hi, Tate Sullivan, cover shipping. I'm an equity analyst at Maxim Group. You heard one of the companies I cover, Pankaj from Hydmar, talk earlier about mostly interacting with retail investors for himself, but then on companies that have been publicly listed longer. I mean, we talked about it 3 years ago on this panel with more repurchases in the sector, more dividends, decreasing leverage. Today, there was a debt announcement at SOFR plus 135. 2 years ago, it was SOFR 185, 200, based on a quick look at some companies in their annual reports. So these powerful capital structure dynamics have attracted more institutional investors into this space, in my experience. After companies have been listed, got larger than the institutional investors.
Nicholas?
Yeah, I mean, I think, and by the way, Nicholas Stillman, I run Olympic Maritime Partners, which is a shipping-focused fund with actually two different strategies in parallel. One's on the credit side, and one is sort of long-short on the equity side, sitting side by side with about 2/3 on the credit side, 1/3 on the long-short equity side. But I think the tricky thing for institutions, coming in as well into shipping is that, one, the liquidity is real in terms of the trading liquidity of shares. I've been doing this for 7 years now. Before that, I was 15 years as a banker. And in many road shows and discussions, I didn't fully appreciate till I was sitting on the other side of the table how important trading liquidity is to make vehicles investable for the investment community, even at my smaller scale. I can't build positions in most of the names that trade publicly today, other than like the front lines and things like that are super liquid. And so, it's talked about every year, for decades now. We've heard in the various panels around trying to get to a bigger scale. It's ultimately very important to be able to make the space more investable, because I think there's also this conundrum that has always been the case too for decades in the public markets and shipping, where everyone wants pure plays to like trade in and out from the institutional community, which is really friendly for the hedge fund community like me. But ultimately, if you want to have investors through the cycle, a lot of those vehicles can't actually last the cycle, pure play individual sectors. But at the same time, it doesn't, the diversified companies trade at seemingly conglomerate discounts for actually attracting long-term capital that's sticky and will stick around. And so I think the community hurts itself because you pursue I want to be high dividends in a single sector company, but in reality, unless that company has no debt, can't survive through multiple cycles when it goes to OpEx. So I think the market finds itself in a tricky position, but liquidity matters.
But Chris, Nicholas's point, which is shipping's the Hotel California. You can check out, but you can never leave because there's no liquidity. Do you find the institutions you talk to are voicing that complaint, and that's the biggest complaint?
Yeah, absolutely. Chris Robertson from Deutsche Bank, Vice President of Maritime Shipping Coverage and LNG Infrastructure. Been coming to Marine Money since 2017, first under Doug Mavernack at Jefferies. So big shout out to Doug and also Randy for bringing me into this wonderful sector in the first place. So absolutely, our clients, obviously we cater to more large institutional investors at Deutsche Bank, so our clients are certainly concerned about liquidity. A big issue for them, there's a lot of momentum and theme trading in the market that we see, and by the time they get up to speed on the shipping sector, kind of the disruption is over, they moved on to the next theme, right? So they want to have market cap and they want to have trading liquidity to get in and out. I know we had done some emails back and forth about, do you marry shipping or do you date it? So they're looking at it from a dating perspective, although I think there is, depending on the point of the cycle, you want to have, everyone's going to make money in trough to peak, right? We all kind of know this, but I think the key for attracting long-term investors is how do you grow trough to trough, or how do you grow peak to peak, right? So over the long course of the cycle, and there are companies with sufficient market cap and trading liquidity, but also quality management. So we'll talk about those in our top picks later. I'm thinking about companies like Seaways and Starbulk, for example. You want to have consolidators in the industry. That really attracts the longer-term capital, and we do have clients in that space. But it's been amazing to see, over the last few years, there's a growing presence on social media. There's a growing presence in Discord communities, for those of you who know what Discord is, Twitter, social media, newsletters. And some of my peers on the panel, like VIE, for example, does a great job in reaching that part of the market where, large institutions like Deutsche Bank, that's not what we're really going after in terms of clientele, so.
Well, that's a good lead-in, Clement. You guys have an interesting model, and you have investors who are listening to you. And talk about your investor base and what they want out of you.
Well, I'm Clement Molins, head of shipping research at Value Investors Edge. And all right, so Our clientele, I would say, is pretty broad. It goes from hedge fund managers to institutional investors to high net worth individuals who invest as retail investors. So our offering is mostly research on all shipping segments, going from dry bulk to tankers to container ships, LNG, LPG, etc. And well, we cater to their needs. And obviously, for example, Chris, their offering is more tilted towards institutionals. We try to fill in for more retail or high net worth individuals.
Okay. And Omar, I heard you earlier today on the panel saying we're not allowed to use those dreaded words NAV. But what are your investors interested? Free cash flow, rate of change, scale, growth? Talk to us about what the investors want from the shipping companies.
Sure. Thanks, Peter. Yeah, Omar Nokta with Jefferies, shipping analyst. First off, I would like to say that dispel what maybe Peter G was saying on the last panel about investors don't care about shipping. Investors very much care about shipping. I would say investor engagement is very high, and it's the highest it's been in a long time.
You mean because we're going to give them their toys?
I mean, there's so much going on in this sector, but also when we think about where shipping is, right, it's highly volatile. There's so much going on, and you can't be asleep at the wheel. You have to monitor what's going on, whether it's cross-industry, tweets coming from the White House or whatnot. But what's interesting is, so is every other stock that's publicly traded today. Nobody can invest long-term in today's market. Everybody's got to have a short leash, and so I feel like tankers is starting to even become more, or tankers definitely because it's been topical recently, but shipping in general, there's a lot more investors that are looking at the space, I would say, today versus 12 months ago. Definitely, in my career, I would say I'm the busiest I am right now. So shipping, very much people care. What they don't care about is paying NAV, right? And I think that's where there's a lot of apprehension on the part of companies about issuing stock, because it seems to be the only way to think about whether a deal's accretive or not. There's other measures to figure out whether a transaction makes sense. Are my earnings going to grow? Is my EPS going to go up per share or not after this deal? Who cares about NAV? It's about EPS. I think at the end of the day, that's what it is.
Okay.
Just adding to what Omar said, I mean, at this dynamic, the global dynamic we have in the market, I don't know why all investors aren't looking at shipping. So I look at that as part of my job as an equity analyst, to make the links to what's going on in the geopolitical space, what's going on with trade, what's going on with everything else, international concerns, and link it all to shipping. And to me, it's the center of a lot of considerations for investors. So, I mean, that's part of our job as equity, or at least I view my job as an equity analyst, to make those links.
Okay, let's move on. Having raised billions and taken 4 companies public, I think the inside plumbing, how you market and promote and retain investors is important. And I'm interested in how shipping can get a better throw weight. And Ed, you are an influencer, and you're in this new social media. Do you think shipping companies are doing enough in the social media space, and how can they move into the modern 21st century?
So Ed Finn, I spend all day gossiping online. That's what I do. The answer is no, they don't do enough. And I think it's a big problem because most companies see social media as window dressing or something that they're obligated to do in addition to their job in 20 minutes per day. They don't think of it as a core communication tool. And I think that I agree with Omar that there's never been more interest from investors of all sizes in shipping. And they want to learn. They're hungry for knowledge. I hope someone in this room will forgive me for telling this anecdote, but I was speaking with somebody who's the daughter of a very well-known person in shipping, and she just started working in shipping herself, and she was telling me that at first, when she was reading the research, she thought that bunkers meant the cots that the seafarers sleep in, and that when bunkers were getting more expensive, it was actually the accommodation for the seafarers. So, I mean, obviously, when you learn a sector from ground zero, that's really tricky. And the point of the anecdote is that there is no repository of knowledge to get up to speed. So you have people from the outside who might be used to how cyclicals behave, and that leads them to become interested in shipping. But there is nowhere to learn these things unless it's like an oral tradition. Like in some anthropologies, you have Aboriginal traditions which are only transmitted. There's nothing's written down, and I think that's a huge problem for shipping, because there's nowhere for someone who is diligent and meticulous and willing to do the work to learn these things. There are no anthologies. I mean, I was reading at the public library here a couple days ago a book written from the 90s, and it's funny because it reads like science fiction. They're talking about LNG carriers as if they were spaceships. They were never going to be adopted. This is too complex, too dangerous. And it's kind of the way we talk about ammonia carriers today. But again, the point, coming back to your question, is shipping companies need to do more to help investors get more engaged, because the only investors who care about shipping are the ones willing to do the work, to read about the demand side, to understand energy markets, and they're going to do the digging on their own. But if shipping companies don't help them with a minimum of information and helping them have like a framework to use, they're never going to take that step. They're just going to trade a stock which is much easier to understand around a theme like a data center for AI or something, that they don't have to spend hours and hours reading textbooks to understand what petrochemicals, the difference between ethane and ethylene, for example.
Yeah, but for example, Twitter, when you're looking at any other stock, you put in the stock symbol on Twitter, you see the whole social media out there. You guys are cutting videos, they're also on TikTok. Omar, you cut videos and talk about shipping, and maybe, I don't know if it's inside the paywall or outside the paywall, but for the whole panel, how can shipping get into the 21st century so that retail can talk about shipping stocks?
I feel like they are.
You don't think?
I feel like retail is very much engaged in shipping. There are very few. They're selective, perhaps, but it sounds like maybe it's like 10 to 12 of the companies that I follow seem to be very much talked about on Twitter. You can tell they have outsized moves on earnings days or on certain announcements or on dividends. So I feel like the retail universe is there.
Do others feel that there's enough throw weight?
Well, I think there's a slight disconnect where there is a huge following on Twitter in the retail community. I am not a Twitter fan, but a few years ago, I realized that actually I had to sign up for a Twitter account merely to follow the messaging and flow and just what are people talking about. And there was so much dialogue occurring in social media that if you weren't following it at all, you were just missing. And it wasn't just a matter of retail or institutional or otherwise. It was almost a necessity. And today, I'll tell you, especially in this geopolitical environment, I'll see my screen go from red to green instantaneously or green to red, and I'm wondering, basically having to jump on Twitter to see, okay, what tweet just happened to either blow up my portfolio, one way or another. And genuinely, it's that. It's a tweet from the president or something or someone, and it has instantaneously changed the market in that moment in time. And so if you're not following that, you're just missing a whole dialogue.
Let me jump in here. One of the disconnects I see on reactions of social media and things getting out there is that there's a lot of talking about these issues. There's not a lot of deep scenario analysis around them. And in a changing world where we're shifting from a unipolar world to a multipolar world, we have geopolitical disruptions seemingly every week, tweets going in and out, et cetera. One value add that shipping companies could do, and I think, is just lean into presenting various scenarios and outcomes. They have the expertise of being in the markets for so long. It is difficult work. You have industry research providers, whether it's commodity flows, data, et cetera. They try to do that analysis as well. I don't know if myself or my peers here have really the bandwidth to be all things for all people in terms of commodity research analysts, equity research analysts, et cetera. But that's an area where shipping companies can lean into their expertise and present to investors, here's what we think the probable outcomes will be and the ramifications for those, so that people can get their minds around more of a deep dive analysis.
Might I just add that I remember when I was an equity analyst back in 2020, we had the contango market in oil tankers, and I was active on Twitter. I downgraded oil tankers to sell in around March or April. And I never received so much negative feedback ever.
And you had to move?
Yeah, I was right in the end, but it took a couple of weeks. No, but my point is social media is very positive biased. So you don't get the discussion. It's only if you have negative comments, you're probably just going to get pushed out of the discussion pretty fast.
I think if I may chime in, the main issue with social media is that there is a lot of noise and it's hard to find the signal. So like there are people who we trust, here we have one of them, but there is also a lot of noise that will simply clog your mind. So being able to differentiate between noise and signal is, in my opinion, the hard part.
But you think they should do more, Ed, shipping companies, to promote themselves?
I mean, it depends on the company, right? If you take a company like Navigator Gas, they do an extraordinary job of communicating because they have to, because the business is so complex and because most investors, even if they've done some of the work, they still don't understand the nuances. And the market's changing constantly in terms of the cargoes they're able to carry. So that's an example of a company that does the work. However, fundamentally, it is so complex. They have a slide deck which is 50 pages, and every single page you could spend hours studying and then further educating yourself to understand. So, I mean, I suppose also this is true of equity analysts. I find that a lot of the research is in a similar format with a similar tone, and they talk about similar things. So it's not necessarily a criticism, but it's less engaging than if they were to, say, adapt the format to the content they were trying to talk about.
Okay.
So, but I think that you have to think of it as an educational aspect. This is what I tell companies, actually, when I meet with them individually. It's really, it doesn't build gravitas or trust if they're just constantly giving you the bull case of every single scenario, and if they're promoting themselves as the best company in the space. But if they talk about the market, it gives them an opportunity to establish credibility indirectly by demonstrating their knowledge and their acumen. And then indirectly, you say to yourself, okay, this is the company I want to invest with because they understand the market better than the other people. So it's not as much direct marketing as it is discussing with a fellow market participant. But maybe that's too subtle for most companies.
Okay, but that's a good segue. So what matters more, macro or company-specific moves like management and operating record and cost-cutting and corporate governance? Nick, do you want to start us on that?
Sure. I mean, I think if I were to rank them, I mean, they both matter. But if I'm ranking them, the macro matters more. But as a second derivative, all those other factors ultimately do drive valuations and discounts and otherwise in a space. But like if you just look at what happened in the second half of last year, there was no, almost governance difference. If you looked at everything that peaked in the summer and bottomed in December, they were all down about 50%. Now, they may have been different relative valuations, but like product tankers, crude tankers, dry cargo, there was a sort of coordinated, sell-off, and no one really escaped unscathed. And it didn't matter what sector you were in. There was just a risk off into the period, and that was a macro-driven. It didn't matter what your government's policy, didn't matter what your dividend policy was. It was just selling off the space. I think, so that is the ultimate driver as to the fundamentals. But in terms of within that circle, things like governance and policies are absolutely critical factors, and certainly from my perspective, that is something I look at closely. And apply a different framework depending on what I think of management, what do I think of their policies, how they approach the business. Am I concerned that they're going to do the wrong thing? Do I have a question even that they're going to do the wrong thing? That's its own discount, let alone do they actually do it, versus someone or a group that I have no concerns. And my only concern is about what is the market going to do, and that has its own dynamic. And so.
Is everybody on the macro train first over companies specific?
I think it's like a checkbox for the shipping sector, and my interpretation is if you have an uncertain geopolitical environment going forward, check, and then look at shipping in my mind. If you have a balanced capital allocation approach, check. Okay, which companies do I have that? Then I'd look at future catalysts too. I mean, the sector. And I'd relate that to trading efficiencies. Right now, you have Capesize rates indicated available rates at 30,000, with the dry bulk names hardly trading up to that or indicating that in their forward earnings projections at all. So you have to look at the look at the trading inefficiencies and other catalysts such as repurchase. So yeah, macroeconomic check, and then look at the individual considerations like future repurchases or the trading inefficiencies right now. And I point to dry bulk right now in that regard.
Chris?
No, I agree. To use a Wild West analogy, which always comes up in shipping, the wagon train might be going in the same direction, but which horse do you want to hitch your wagon to, right? So that's where corporate governance comes into play. And I also just think quality management decisions reflect in the earnings power over time in terms of maximizing your profits during the good times and protecting your downside during the bad times. And that all comes into play in terms of how they allocate capital, what's their balance sheet structure, lowering break-evens, et cetera. So I think it does come full circle in the end in terms of management quality.
Joakim, are we macro or are we company specific?
We're definitely macro. So what we do is we identify the cyclicality, and then we want to allocate to each shipping segment, and we define how much we want to allocate using our kind of portfolio optimization models. And when we have that overarching allocation, we look at how do we allocate in this segment, and then we look at equities, bonds, derivatives, FFAs. We can look at everything. And at that stage, you come into the corporate governance. So then we look at, we perceive equities, for instance, in tankers as attractive at those at current levels. And then we look at which companies do we want to allocate towards. And then if you're not paying out your capital as dividends but retaining it, that's a negative on our in-house scorecard. If you have inferior corporate governance, if you have companies you run on the side doing fees on commercial management and ship transactions and all that, that's definitely a negative which we apply to your valuation. And then we get the full overview of all the companies, and we get then a mathematical approach to how much we should allocate to each company. So that's how we do it in practical terms. So if you have inferior corporate governance, you're getting less capital allocated from us.
Okay, we've made some news. This just in, AI is going to replace company senior managements before it takes out anyone else of shipping companies.
I can add that that's a subjectively scorecard we apply on corporate governance. There's no AI involved in that or mathematics, but it's a subjectively one.
Okay, well, you got to get invested. Okay, so now let's get to the main point, which is what are your stock picks and why? And why don't we start with you, Omar? Give us your best stock pick, why? Is it the sector? Is it the management? Is it the retired CEO?
That's a great company, too. I was going to say Dorian, symbol is LPG. I like that company a lot. I think, a very good management team, not afraid to return capital when it makes sense. Strong balance sheet, but it's operating within a sector that is underappreciated, and it's the VLGCs, and it's the export of US LPG, and also the Middle Eastern LPG. Those are the two main trades. But people have been very fixated on the amount of new buildings coming on, but this sector just continues to deliver high demand growth. And that's the part we think is underappreciated. And when we think about what's happened here, say, recently in the Middle East, where you've had a jam up in rates across different asset classes, different segments, VLGCs were the only one that came from a position of strength into more strength. And I think that just tells us that market's strong, and it's that close to really taking off.
Yeah, $2 million a month. I look forward to getting my daily email on where rates are moving. But yeah, by the way, that was a great call you made last week, I think, on the VLGC market going up with that.
Thank you.
And looking at that. So, okay. Chris, what's your pick?
Sure. Yeah, I have a perspective of I like sectors that are currently out of favor. I want to be looking for ahead. So I'm looking at dry bulk at the moment. I have a chart which James Doyle from Scorpio has also used in their presentations. It's fairly simple. The x-axis is the average age of the fleet. The y-axis is the order book to fleet ratio. We've had several years of under-ordering in dry bulk. If I'm thinking about it in terms of playing blackjack, right, I'm counting the cards. I keep count, right? And the count seems pretty high right now in terms of this is the time where any geopolitical shock, demand side, upside there is going to cause that sector to really be more in favor. So I'm looking at Star Bulk, looking at Genco as well. I think, like I said earlier, when we're moving from a unipolar to multipolar world, I know this term deglobalization gets thrown around a lot. I don't think that's what we're seeing here. I think we're actually seeing supply chain diversification. And so when I look at emerging markets that have growing populations that are young, that they're industrializing, that they're increasing manufacturing, they're increasing their energy intensity, and they have urbanization, right? So Southeast Asia, South Asia, et cetera. I see the next leg in the dry bulk market from those emerging markets, and especially as trade relations with China are strained and people are looking to diversify their supply chains, I think it's an interesting and underappreciated story.
But is that because iron ore is going to go up, or coal? We talked about new iron ore coming on from Africa. Or is it ags because these people got to eat? What's behind the dry bulk call?
Yeah, I think the point has been belabored in earlier panels around emerging supply in terms of iron ore, et cetera. It's really the trend around an emerging middle class, growing middle class, people need to eat, and growing populations in those areas.
Okay.
Yeah, so it's really all of the above in terms of the commodities. But I do think there is concern on the dry bulk side of China's been such an important theme for the last 20 years, let's say. And investors are a little bit wary of what happens when we reach peak Chinese steel production, or what happens when we reach peak kind of economic growth in China. But I think the underappreciated part is when you're moving from that trend, which has persisted for many years, and it's not always clear around what the next trend is. And again, I think that's where the market is underappreciating dry bulk. You have an aging fleet. You don't have a lot of renewal here. The prospects for retirement in the fleet, I think, seems pretty high around the environmental issues and regulations. And then this aspect as well. The world will continue to grow. The world is continuing to urbanize. It's going to take raw materials to do so.
And Hamish buying back shares is also a good thing?
It's a good thing in the short term. Hamish, at many panels over the past few years, is hung up on the PNAV situation. I'm less so. I think we often have to keep in mind here that price to NAV, there's two variables in that, right? So there's the discount to absolute NAV, but that NAV changes over time as well as asset values fluctuate. So the market isn't necessarily saying that we're valuing the company at below liquidation value. What the market could also be saying is that we expect asset values to fall, right? So there's two moving parts there. We have to keep that in mind. So, I think having a stable dividend policy over the long term is more important than short-term share repurchasing.
Okay. Tate, what's your call?
Thank you. I like that you mentioned Starbulk, and I always look at the repurchases, the dollar amount of Starbulk as an indication of their future confidence for the sector, for their company specifically in the sector in terms of the long term. But considering the panel today, thank you very much for the invitation to be on part of the panel. Thank you for your questions. I thought about dry bulk versus containers versus tankers. I put dry bulk second. With my top pick in the Capesize market, Synergy, SHIP, but my top pick today, I choose to ride the momentum in terms of the urgency of getting goods to market. Where is that? And I think it's going to continue to be containers. I've talked about containers on this panel before in previous years, but I think it's going to continue to work. And the name I'm recommending is Euroseas, 5.7% dividend yield still. It's still about 5% below its all-time peak price. It's had good momentum, reported earnings this morning, and I still don't think that's reflected in the stock. It hasn't been a variable dividend. It's been an increasing dividend since 2022, and 5.7% is attractive to me. And I like the container. It's a smaller space within shipping. I mean, there's limited names. I mean, the pushback is limited volume to get into this space. But structurally, it's a smaller space for investors to invent. There's scarcity value, and then I think you get higher share prices.
And you don't want some Zimlicious volatility?
That can add to it, but yeah, I like this. I like the consistency of Euroseas and then actually the container ships.
Okay. I was on your Twitter feed, Ed, and you posted with all the markets going up, big arrow up. So you have a huge amount of companies to pick. So
yeah.
What is your selection?
I mean, I could make a bullish case for most of the sectors actually at the moment because valuations have come down so much. And fundamentally, I don't think there's major problems in any of them except for the Red Sea normalization, which it keeps being pushed back a month. in terms of containers and the ton miles there, but I would encourage people to take a look at offshore supply vessels because it's debatable whether they even are part of shipping, but I think that they have the most attractive risk reward set up right now in terms of being mid-cycle, in terms of very limited supply, an aging fleet, and very steady demand ultimately. I think it's also interesting because it's a regionalized market, so the way that the market operates is different in Brazil than the North Sea, than the US Gulf of Mexico, or the Middle East, or Asia, and all these different places. So it's interesting to research. It's also quite opaque, so most people think it's more complex than shipping, but it's not. And my pick, if I would have to choose one, is Swan Offshore, which is a Norwegian company, Norwegian listed. And they commercially manage another fleet of very high-spec vessels for Viking Supply, which is a Swedish company and is also listed in Stockholm, but the problem is that the majority owner owns 88% of the shares, and he's still buying in the open market, so you just can't buy that company. If people are looking for a US-listed company, Tidewater is superb. Their capital allocation is very consistent and well thought through. They're predictable. They have excellent LPs, and it's a huge fleet. They're going to continue consolidating. But I also could have made a case for LPG. I think now there are two tailwinds in terms of the exceptional demand side of the story. You know, it's easy to talk about supply, but I think that LPG demand is what is growing the fastest every year in terms of volumes, notwithstanding Simandou and iron ore. And now we have a second tailwind in Iran. And I think that no matter what happens with Iran, there's going to be a change in the status quo. And I think that while everyone's concentrating on tankers as the trade, LPG is probably going to be even better because Iran, I think they have 55 ships which they control out of 400 VLGCs, and those flows are going to have to be normalized somehow, no matter what happens. Whether the Ayatollah is there in 1 year or not, the status quo is not going to remain as it is, and those are old ships. So
yeah, but those are short-hauled India mostly, aren't they?
well, they are short-haul, but if they're unable to flow, then that's going to be taken from the Atlantic Basin.
Okay.
And I think on the margin, it wouldn't take much because the market's already tight, as Omar was saying. It's the market's already in a position of strength. So yes, order book coming in 1 year, but until then, we can party.
All right.
Peter, if we're talking about shipping adjacent sectors, I'd like to pitch Golar as well at the moment. So GLNG ticker. In the past, people thought of floating liquefaction assets as being, stranded large offshore gas fields, kind of limited opportunities. But if you look at the evolution of the market today, so looking at Golar's deals in Argentina, and also looking at Delfin in the US Gulf, people are now imagining floating LNG, not necessarily as servicing offshore fields, but also taking onshore supplies of upstream volumes and putting it on a floating liquefaction. It's competing on cost of capital in terms of these large onshore projects in the US are tens of billions of dollars. The US, Qatar, Russia, and Australia kind of dominate the supply market. But if we're looking at a world where optionality and having supply chain diversification is a theme, then floating liquefaction can really come into play here as kind of a cheaper alternative. And so I think Golar is currently undervalued. It's a space I look at quite closely and like the name.
Okay. Climent, what would you recommend?
Well, my top pick in the current market would be Navigator Holdings, ticker NVGS. They've got several things going for them. They're trading, I believe, at a really enticing valuation. They recently instituted a $50 million share repurchase, which I hope they execute on. We'll see. Growing ethylene, ethane, LPG in general, exports from the US are almost a given. As shale turns gassier, additional infrastructure comes online. They recently bought a few ethylene-capable vessels, which they will employ on their own joint venture with enterprise product partners. They've got a lot going for them. They're, I would say, the closest you can get to marrying a peak in shipping. So yeah, that's
Yeah, but Omar's dating, the high velocity Dorian there. You want to marry Navigator. Is Navigator here or?
Randy's happily
Randy,
married,
there you are.
There's Randy.
You owe him some money. No, but let's talk about that. So you're going to date Dorian because rates are rising up and the EPS is under and the dividend will go back up. But So which one do you do, Omar? Do you date or do you marry?
Oh, that's a great question. Well, Dorian, this is a dating situation. It's an off again, on again relationship.
Don't tell her
That's
that.
all right. And all night long it was honor and offer. Yes. Yes. Tate, sorry, we did it. Joakim, what's your pick?
There's many ways to make money in shipping. I believe being long short is the right way to go. So right now we are long oil tankers, mainly in crude. We're long VLGCs. I think that might be a short-term relationship, but we'll see. And we are seeing good risk-reward shorting car carriers and containers. So I thought I would add a risky bet here today, but it's a good risk-reward in our opinion. And we find SIM a very good short.
Zimlicious, here we are, we're back.
So it's actually one of the positions we've made the most money for our investors. And we haven't been long SIM, to put it that way. We have shorted since 29.58 at one point. We have been very much in and out. But anyways, looking ahead, the thing is, it's of leverage. So if we are right in our assessments, and I can add that we are above consensus for 2025, but we are below for 2026. It's all about opening up of the Red Sea. So, but regardless, the supply growth should take containers into negative territory eventually. So for us, it's a good risk reward. It's going to be a bumpy ride, but I think if you stick to it, you're probably going to get a good return on your short and SIM at current levels.
What does other people think about containers? I find them extremely hard to forecast because there's so much cargoes moving around.
I was going to say maybe just a bit more bigger picture or longer term. You know, when we think of conventional shipping, tankers, dry bulk, and containers, the demand story has been tough in all three. And containers especially, where it went from 2 to 3 times GDP back in the good days to a fraction of GDP. Chris brought up this point of it's not necessarily deglobalization, but diversification of supply chains. But that's something to look forward to, I think, in containers, where we may actually see the container trade actually start to grow much more meaningfully than we've been seeing, because you're going to have cargo getting partially constructed in China, then moving to Vietnam, getting fabricated further there, and then making its way to the U.S. And you're using 2 ships to move 1 cargo. And so if that trend really starts to take shape, we may be painting a pretty strong picture long-term for containers. It's still early. It's not a thesis that's out there, but it's something that seems to be something on the come that would definitely, we think, change the landscape for containers.
I'd also like to see, thanks, so is more data from the companies and from the industry itself on what's being transported. I mean, I'd like to build a thesis around a shift in the cargoes being transported, whether it's different types of critical minerals being transported, what have you, and then also the shorter trade routes outside of China. So then in a way you can move away from any risk from some of the risk related to China.
I think container ship lessors are in an interesting situation, since indeed I believe the market will weaken going forward, especially if the Red Sea reopens again. But at the same time, they've built quite sizable backlogs, which ensure that 2025, 2026, and to an extent, 2027 will be excellent years. So residual risk is very limited. I mean, it will be very interesting to see to what extent the market can punish them despite this backlog. So it will definitely be an experiment.
Yeah, I would just like to add a nuance to what Climent just said, because I've noticed that in shipping, you need to have a further horizon ahead of you to project your hope into, and if everything is locked in, I think that the investment community does not reward you for taking that risk off the table. It has to be about volatility, which you can project in the future and fantasize about and imagine that it's going to go even higher. But the safe plays, regrettably in some ways. I think another good example of that is Diana Shipping, a company which just does nothing but rolling time charters. And in strong markets, they don't benefit from the upward volatility of their peers. And in weaker markets, they sell off just like everyone else. And you see this across all shipping sectors.
But do you find that investors embrace and love the volatility. Most people think volatility is bad, but a good trader thinks volatility is good because it gives you option value. You can move it in, you can move it out. So the investors and who you talk to, are they in shipping because they actually are risk junkies?
I mean, it's highly volatile. You got to have a stomach and a heart for it. But this is the perfect market and sector, I believe, for a hedge fund strategy because it's several segments. They're uncorrelated. So current markets, we see upside in some segments, we see downside in others. And we put together a portfolio which are with the segments with no covariance between the segments. You can enhance your expected Sharpe ratio by having a low expected volatility and high expected return. So yes, there's volatility in each individual segment. When you put together a portfolio of this, it's a very good portfolio. And even if you go another level and put that portfolio into your broader portfolio of real estate, industrials, and whatnot, you can really kind of increase your expected returns without or actually diminishing your expected volatility.
Okay, so final lightning round. What is the unknown unknowns, the black swans, which people aren't thinking about? Ed?
The fact that there won't be enough recycling capacity to take all the dark fleet vessels.
Excellent. Ooh. Clement?
I will say environmental regulations and Taiwan. I think it's very unlikely, but it's something we must keep in mind.
Taiwan. Ah, okay.
I mean, the nature of a black swan event is making it hard for me to predict them, but I think you've seen dam collapses in Brazil, you have seen pandemics, you have seen wars. So it's hard to tell, but I think it disrupts shipping. Some of them are positive, some of them are negative. It's almost impossible to position for them ahead.
Considering the black swan, I was one reason I picked a sector and a name with longer-term contracts. So my concern is a currency devaluation of China's currency, CNY.
In terms of, we see the market turmoil today, a lot of volatility, but I think actually the black swan's on the other side of it as in the sense of peace and trade negotiations and things actually calming down.
Yeah, okay.
For me, it's sort of related to the recycling of the dark fleet, but I think there's a legitimate unknown as to what happens with the dark fleet. It is such a material amount of the tanker tonnage. It is such a material amount of not only the tonnage, the actual oil flows related to it, and I know everyone has varying views, but I think the reality is we don't know exactly what's going to happen to that fleet, and it is a significant portion of not only oil flows, but the tanker market. You can perhaps assume that the old rust buckets definitely go, but there's a whole lot of younger ships that, you can't say with certainty that they're either going to go back to trading or they're going to go back to class or they're not going to, because it is such a large segment of the fleet that, you tell me what happens there, and that's going to be part of the outcome of the tanker market, and I can't predict that.
Omar, bring it home.
Sorry, Peter. I spent the last 90 seconds racing, trying to come up with one. I can't, but maybe what Ed said.
All right, there you have it. You got some great picks. I was actually surprised at how broad they were across the way. Nobody mentioned car carriers, short or long. So that was the only one left out. I want to thank the panel very much. Very good insights that we had, and Jim's looking down on us and smiling. Thank you.